Determinants of interest rates for Treasury bonds.
By the Joe and Phoebe Money Show. Hey Joe, you are always interested in the bond market and interest rate, right?
Not really. I am more interested in basketball and video games. Anyway, how can I help?
I would like to know what makes interest rates move up and down.
There are so many interest rates. Investment-grade corporates, high-yield bonds, etc. But let's just focus on Treasury bond yields for now.
Yes. Let's just look at Treasury or government bond yield because this is the base rate. We can talk about how corporate default risk premium is added on top of this Treasury yield at another time.
Okay. First, most people call this government bond yield risk-free. It actually refers to default risk-free because of the expectation that the U.S. government can just print new U.S. dollars to pay for maturing bonds without the need to default. Of course, if the government or the Fed were to print more money to redeem the bond at maturity, the increase in money supply over time can contribute to an inflation problem.
Yup, these Treasury bonds are still subject to capital gain or loss. After an investor has bought the bond, the market price will go down if the market interest rate goes up. And the bond price goes up if the interest rate goes down.
Correctamundo. The textbook says that one of the key drivers of the market interest rate is inflation expectation. The higher the inflation expectation, the higher the market interest rates are.
This means if I expect inflation to go up, I will expect bond prices to be cheaper, reflecting higher market yields. But what will cause expected inflation to go up?
I can think of two factors. Demand pull inflation, when the economy is stronger than what is expected by the market. Cost push inflation, which includes OPEC decision to push oil prices higher, weather problems leading to crop failures, and higher rent or house prices.
But there are also deflationary forces, like the composition of the population. In general, developed countries with a higher proportion of retirees will have fewer demands for goods and services while there are tons of supply of goods from developing countries. Industry disruptions which find ways to bypass the middleman and reduce prices to the consumers. Too much debt. Since this debt has to be repaid, this reduces future spending and future demand for goods.
All true. If you buy bonds, you want to earn an interest rate that is higher than your expected inflation rate for the future. The interest rate that you get in the market is the nominal interest rate. Nominal rate minus inflation. You get real interest rate.
This relates to the negative real interest rate in Europe. That happens when the strong demand for bonds, mainly due to the central banks buying, which pushes up bond prices and market rates down and can even go below the expected inflation rate. And could even go below zero, and that is how we get negative interest rates.
Yes. While some investors would be happy to sell these treasury bonds at such high prices, many large institutional investors like foreign central banks and insurance companies have to keep holding treasury bonds because of regulation or investment mandates.
So, to summarize, the textbook says that bond yields are affected by expected inflation. But in practice we are still back into the supply and demand framework, where if the central bank buys enough of the bonds, it could push bond prices sharply higher and yields sharply lower. And the yields can even go below the inflation rate.
Strange but true. And I am going to sell the textbook back to the bookshop. This presentation on determinants of interest rates for Treasury bonds is brought to you by the Joe and Phoebe Money Show.